Very flat. The Nifty just holding on to 18,600, consolidating around that mark. That seems to be the pivot in the last few days, the 18,600 mark. The Bank Nifty is also very quiet right now. The advance decline ratio is well in favor of the advances. The big stocks moving, Adani Enterprises, there's some positive news flow on the balance sheet over there. So Adani Enterprises is up almost about 3% odd. Bajaj Finserv is up about 0.5%. Maruti Suzuki is up 0.6%. The pricing of the Jimny will be out tomorrow, and that's the next big launch for Maruti Suzuki. It competes with, the very successful Thar from the Mahindra stable. So very exciting times for the Maruti, group. Up almost 1% there. Tata Motors is up about 1%. Eicher Motors, positive commentary from the management. So 0.5% higher on Eicher Motors. Autos are doing pretty well. On the flip side, it's IT that's taken a bit of a backseat this morning. Infosys, Tech Mahindra, HCL Tech, TCS, Wipro. All the IT stocks are down anywhere between 1 to 2%. You also have Pharma, which is not doing that well. Sun Pharma, Divi's Labs are in the red right now. And then you have something like a Cipla that's also in the red, down about 0.7%. So the market is balanced. On one hand, you have autos on top, and then you have ITs below. The Bank Nifty is also supporting the bulls a tad bit. So 40 points higher for the Bank Nifty, trending in the green. And Eicher Motors, as I said, is one of the top gainers right now, 0.5% higher on that.
Well, that's right, Sona. Mid-cap IT is pulling back a little bit. Persistent Systems is down close to 3%. Emphasis is down close to around 2.7%. And you have L&T Tech Services as well. That's down more than 2%. So a few of those names falling on fairly decent volumes for the first couple of minutes. You have JK Cement, though. They made a small acquisition. Foray into East India, the street likes that. The stock is up close to around 1%. Ambuja Cements as well, holding with a gain of close to around 1%. From the broader markets, BL Kashyap, they won a new order, so the street likes that. The stock is up close to 7%. Maskaun Dock, well, continues its big run. It's up close to 5.5% as we speak. So good up move is what we're seeing out there. Sanghi Industries as well. I think the first tick was in the green. Remember, we are aware that asset is on the block, but the valuation is something that the street will be deliberating on, whether or not the promoter entity will sell at the price that is being offered. So that's going to be important. For the time being, the stock is up close to 2%. But a flat start is what we have got on the index. Prashant.
All right. Well, it's absolutely blinking like a traffic signal, right? Red and green, nothing on it very much. 8 points lower. Mazagon Dock is the top volume traded stock once again. It's coming right on top. A 6% gain at 1,041 on Mazagon Dock. All three shipbuilders, Mazagon, Garden Reach and Cochin Shipyard, were flying away yesterday. And I can spot at least one once again right there on the top of the list. You got, stuff like Data Patterns is another one. MTAR Tech, I think we mentioned. BL Kashyap, but it's small right now. Volumes will pick up, and volumes have not been a problem. The up move in the broader markets has been supported by volumes over the last many weeks now, so that really has not been a problem. But right out of the gates this morning, this is a little quiet so far. On the downside, apart from what we've already mentioned, Emphasis is down about 2.5%. BHEL is down about 2.5%. BHEL, of course, we highlighted with Vivek earlier. And you've got a lot of tech which is down, but between 1 and 2.5% or so is what we have at this point in time. So quiet at the word go right at the outset this Tuesday morning. Well, our market master of the day is Ridham Desai, and he's joining us right now from the sidelines of the Morgan Stanley India Conference. His recent report, published on the 29th of May, titled How India Has Transformed in Less Than a Decade, has been the topic of discussion and much enthusiasm since it was published. I can say that I've spoken with Ridham on markets on the air for at least 15 years, and I can say that apart from tracking micros, Ridham also zooms out and looks at the bigger picture for India. For example, earlier, just this year, he published a report titled Why This Is India's Decade. Ridham, it is a great pleasure speaking with you. Thank you very much for your time. Appreciate it here on CNBC-TV18. Let me start by asking you a simple question, Ridham. Out of all the transformational changes which you list out in your latest report, which is the one, to your mind, which will remain the most relevant for investors over the next many years? Which one is the most durable, according to you?
Hey, thank you, Prashant, and thank you, all of you, for having me here on CNBC. Glad to be back. So, Prashant, that's a very difficult question to answer, because there is never, at any time, there's never one thing that makes the difference. If you're going to push me to the wall, then maybe I would say that achieving macro stability via inflation targeting is the likely standout. But then you cannot undermine the creation of infrastructure, which is so critical to doing business. You cannot undermine the success that we've had in engineering social transfers and reducing leakages, because all these things have led to this transformation that the economy is currently experiencing. So very difficult to point out one of them, but maybe these three are standouts, and there are more, of course. And it is like if you do one thing, then you achieve one result. If you do many things, then you get a compounding effect, which is what I think India is experiencing today.
Absolutely. Rhythm, hi, good morning. This is Sonia here. A lot of the macros have improved substantially, right? Whether it's the GST collections, the PMI data, GDP growth, even, things like auto sales, for example, come back after a long time. But do you think a lot of this is in the price as far as the Indian stock markets are concerned? Because we are virtually at all-time highs now.
Sonia, the market is not yet at all-time high, but remember the level that we are trying to cross is the one that we achieved in October 21. So effectively, we've done nothing for the past 18 or 19 months. And in the meanwhile, it's not like earnings have degrown. Earnings have only grown. I think we're ending F23 with about a 16 to 18% growth rate. So yes, in October 21, the market had probably gotten a little ahead of itself and needed to go through this really long consolidation period that we have seen. Also, it was accompanied by significant outperformance that India experienced, because the rest of the world was very much in tatters through 2022. And when the rest of the world, and when I say that, I mean emerging markets, started making a bit of a comeback in October 22, India underperformed. And then we have suffered this underperformance until March. So I think, the all-time high is not a relevant data point in assessing how much is priced in. Rather, we should, adjust the market for expected growth rates. And it's not like that the market doesn't know that India is likely to do quite well over the next 3, 4, 5 years. But all of it will never be in the price. And the common thing that the common refrain I hear from investors is that India trades at a high P multiple. But then earnings are very depressed. Remember, profit share to GDP collapsed to 2% by 2019, is now back to 4%. But is likely heading to 8 in the next 3, 4 years. So there's a lot of compounding of earnings that's still left to happen. And in that context, I don't think stocks are that expensive as they look on the headline basis. You have to adjust corporate profit margins and make them normal. And when you normalize earnings, stocks are actually still a buy.
Hi Rhythm, good morning. Always good hearing your thoughts, and went through a bit of your note as well. Rhythm, urban India is doing very, very well. And India definitely is on the path, and everyone's very bullish. The only problem is rural India is still in some pain. I wanted your comment on that, because it appears that, that is yet to recover, which is important from an India perspective.
So Nigel, I think rural has probably seen the trough, and save for some really bad weather that we get in the ensuing months, and a total failure of the monsoon, like a 15% drawdown on rainfall versus average, I think in 3 months from now, you should see pretty good signs of a rural recovery. So the seeds have been sown. Coming out of COVID, rural India actually took it on the chin. Urban had led the recovery, and now it's spreading to rural India. It's inevitable that rural India starts flourishing. So I am actually quite constructive on rural India, and in fact, in our recommended portfolio of stocks, we have a lot of rural players in there, because we think that they should do quite well over the next 12 to 24 months. Again, we'll caveat this by a temporary weather disruption, and that could cause some pain in rural stocks. But aside from that, I think we should be on our way for much better performance, both of the rural economy as well as of the company economy.
Rhythm, one of the things, all right, I think we'll just go back to, and I'll wait for the signal to go back to Rhythm. Let's just take a quick look at the market and what it is doing, it's down about 2 points. I mean, so this is as quiet a day as we've had in the last many. So nothing at all. 18,591 is where we are at. Maybe take a look at a few more stocks which are moving around. So if you can pull these intradays up, Infosys is the top loser with a 1 3/4% loss. I'm talking about volume-backed movers. Persistent Systems is at number 2. It's down about 3.5%. Emphasis is down about 2 3/4%. There is LTIM, which is down 2%. Tech Mahindra is down 2%. There's a lot of tech there. KPIT Tech is down about 1% or so. And Cyient is down about 2.25%. And many others. Coforge is down about 2%. HCL Tech is down about 1 1/3%. LTTS is down 1 1/3%. So in a large way, what is actually putting pressure today on the indices is technology, and I think the Nifty IT perhaps should reflect that. Overall market breadth, it's too early. I mean, it's just been trading for not even 10 minutes, but market breadth is positive for what it's worth. 2:1, 2.5:1 is what we have. Sonia.
Oh, absolutely. Okay, I think Rhythm is ready, so you want to go back to him?
Yeah, Rhythm, you're just fixing that, but thanks for staying on. One of the things which is a change which seems to be a change is manufacturing in India, right? Global companies wanting to set up factories here in India, and we're hearing more and more of that. It's something which we've discussed for many years, never happened, but now looks like it's starting to happen. Do you reckon, from a manufacturing standpoint, India in 2023 is kind of similar to where, say, China was in 2001? China joined the WTO in 2001, and post that growth, really, manufacturing there really took off in a very large way. Or do you think it's kind of exaggerating? It's a very different place now. And but if you do agree, what are implications for investors in your opinion?
See, there are similarities and differences, Prashant. So I think there's some audio problem. Can I be heard?
Yes,
we can hear you, Rhythm. Go on.
Okay. Yeah. So yeah. Okay. Sorry about that. There seemed to be an audio problem here. But there are similarities and differences, Prashant. So I think the similarity is with respect to domestic demand. So I think you have to go a little bit forward in time, say around 2007, 2008, when China's per capita income was just about where India is today. It's when an economy, it experiences a J curve. So it was around $2,200, $2,300, which is where India ended 2023 at. Ended 2022 at. And that's the time when there is a perceptible shift in domestic demand. Now that is what multinational companies want to gain access to. So, one very good anecdote to cite, which everybody will kind of appreciate, is Apple opens its first store in China in 2008. Apple opened its first store in India in 2023. And there are a lot of similarities with it. China's per capita income, China's share of Apple revenues were around 1.8%. India's share of Apple revenues are estimated at 1.6%. So that's the similarity. But that's about it where it ends. Everything else is different. So one of the first differences is the change in the global geopolitical landscape, which is driving a multipolar world, where companies at the margin are seeking to diversify production out of China and take it elsewhere. Now, India seems to be a very attractive place to go to. For one, because it has a market which everybody wants to gain access to for the next 10, 15, 20, 30 years. And the second is that there are incentives that the government is giving to overcome the cost of doing business, via lower taxes and via, production-linked incentive schemes. So that's one difference. The second big difference is where we may be in terms of global growth. So global growth was at a very different level in the previous 30 years. Now, going out into the next 10, 15, 20 years, it's likely that global growth is not as fast. The world is aging, it has a lot more debt on its balance sheet, and is likely to grow a whole lot more slowly than what China did, what China experienced when it was going outwards. So, that's another thing that kind of makes India a little bit different from the situation in India, a little different from China. So, India will have to rely a lot on its domestic demand, on its domestic conditions, and add on the export growth that will come to it. Whereas China, did not need to do that, given how strong global growth was in that period when China was actually adding manufacturing capacity. And the last difference is that, at the time when China was adding manufacturing capacity, I dare say that there was a lot of capacity that the world needed. Today, in a lot of sectors, that is not the case. So it will be a little bit more selective. Having said all of this, we do see India's manufacturing grow as a share of GDP. That, by the way, has stagnated over the last 25, 30 years. In fact, in many parts declined. And we see a very robust improvement in manufacturing share of GDP over the next 10 years. So manufacturing is certainly a renaissance story in India.
Okay, and just in reference to that point you were making about consumer demand picking up, right? We've seen a K-shaped recovery, and the upper portion of the K, the premium end of the market, has come back in such a big way, whether it's real estate, autos, etc. I'll come to that in a bit, but Rhythm, what also stands out for me in your report is you speaking about unprecedented growth likely in the financial services space, and you've put out a very helpful chart where you speak about how between 2012 and 2022 the loan growth that we saw compounded for the financial services space was just 10%, and now the anticipation is from 2022 to 32 it could be a 17% compounded growth. Now my question to you is this: will it largely come from the the private sector banks which are well owned, well identified, or do you see new spaces in financial services that one can take the opportunity from?
So see, Sonia, with respect to financial services, let me cite the starting point. Private credit to GDP is in the high 50s, and that's fairly low compared to the rest of the world. So India is underpenetrated, India is under-levered, especially corporate India, which has experienced a pretty big decline in debt to equity or balance sheet leveraging over the past 5 years. So that sets the stage for what I would say, what I would call a loan boom. Then on top of that, I think India is entering into a pretty sustainable investment phase, because in a lot of sectors we have not added capacity in the last 10 or 12 years, and capacity utilization is rising. So that again supplements the case for a loan boom. So we should experience pretty much higher credit growth than what we have seen in the last decade. Not at the level which we saw in the first decade of this millennium, but much stronger than what we've seen in the last decade. Because in the first decade of this millennium, the starting point was even lower. Corporate debt to GDP was just 25%. Today that number is about 50, down from around 62, 63. I think by the time we are done and dusted with this cycle, this number will go into the 80s. And when you just do a simple math, if that share of corporate debt to GDP is rising from say 50 to 85%, plus personal credit is rising, and GDP growth is say 10%, you arrive at this number of around 17% compounding. So that's one aspect of financial services. The other aspect is non-credit related financial services. That will also see, I think, much larger penetration in the coming decade. So across the board, I think financial services should do fairly well over the next 10 years. In fact, I would say even longer, but we are not going beyond the next 10-year period. So the next 10 years look like a very good period for financial services.
All right, Rhythm, as market commentators, we track the FI flows on a day-to-day basis, and we've been quite happy in the last couple of months. The flows have returned back to India, but it's still a fraction of what they sold in the past. Do you expect more of the same? I mean, India continues to remain the preferred market, going by what all you just said as well. Earnings growth is something that stands out. So maybe these hefty valuations are justified. Your take?
So see, Nigel, one of the reasons, or maybe a couple of reasons why foreign investors have not been buying India. One is, of course, that they are still not comfortable of the valuations, the headline multiples. So we saw some correction in that between October and March, and so foreign flows have returned. The second is the outlook for emerging markets. Remember, it has been quite tepid, and we did change our view on emerging markets last October, and we continue to remain bullish going into the next 12 months. So that helps because India is part of the EM cohort, and when EM experiences flows, India gets its kind of fair share. I would say on the aggregate, foreign portfolios are slightly overweight India, but a whole lot lesser than what they used to be. India was, a very favored market many years ago. It has ceased to be in that category. I think it should attract more foreign flows. But remember, Nigel, in the stock market on a daily basis, flows are zero, right? Because if somebody is buying, somebody has to sell. The problem here is that we have a very strong domestic bid on stocks, and it's not going to go away anytime soon. So if foreign investors also want to buy stocks, and if domestic investors are buying at the same time, and if companies are not issuing capital, then you basically get a situation where share prices have to go up much more quickly. It's not a very healthy situation to be in, but ultimately, of course, those who are long will be very happy with that. They will get very quick gains. What I suspect is likely to happen is that as the foreign bid comes back on a more sustained and larger basis, I think you will see the IPO markets start to open up, and the supply will come, which will then keep price reaction more moderated. Otherwise, you get into a situation where there is a melt up, and then it all ends very badly. So that's, I think, my comment on the foreign flow situation.
That's a very perceptive, important thing. Wall of local money, right? So keeping things bid constantly, and as you said, that's not a very healthy thing. If you have a large portfolio, then you're happy. But if you're looking to buy, then you got to pay top dollar. Rhythm, let's talk about earnings growth expectations. I was looking at earnings growth for the BSE 200 group of companies. This is the top 200, which I think institutions also track. Over the last 20 years, the BSE 200 has returned 16% returns, annual returns in rupee terms, and 13% in dollar terms. If you look at the MSCI emerging market basket, the earnings have grown 7%. That's dollar terms, so 13%, almost. So basically, the growth here has been almost double what we've seen for the MSCI EM basket. What kind of growth should we expect with them, according to you, over the next many years? Will it be high single-digit growth? Will it actually pick up from here in a significant way?
You're referring to the returns on stocks, right? Not earnings growth, are you? I'm a bit confused. Is it the stock market?
Sorry, this is stock returns, index returns.
Index returns, yeah. So I think index returns will be a bit more modest. 16% has to be seen in the context of what inflation India had in that period and what interest rates India had. I think the next 10 years, both of them will be lower, and therefore stock market returns will also likely be lower than the compounding we've seen over the last 20, 30 or even 40 years, because that number of 16% goes back even 30 years or 35 years. In fact, if I'm not mistaken, the Sensex data that I have goes back to 1980, and we'll probably have a similar number for a 40-year period, which is that the Sensex is compounded at around 16% or so. So I would imagine that this number will moderate into the next 10, 15 years. It will be more like 10, 11 or 12%. And that will be in sync with the lower inflation rate India should experience or lower interest rates. The equity risk premium, which is the gap between the equity return and the, say, the risk-free rate, that I think will be more or less the same. But the nominal returns, I think, will be lower than what we have seen over the past 20 or 30 years.
Okay. Another piece in your report which was very interesting to me is the talk about the Indian energy boom, right? And I think this is 1 year where this entire space is expected to come out on its own, because the last few years, although there was a lot of potential, there are still some lingering concerns for adoption of renewable energy, whether it's supply side bottlenecks, the grid infrastructure, pricing issues, etc. But from your perspective, what does this piece look like over the next couple of years? And which are the companies or which are the spaces that could be big beneficiaries of this?
So India has got a huge amount of commitment to renewable energy. We have a COP26 target to achieve, and therefore our view is that over the next 10 years, renewables will dominate the total energy capacity addition. Our estimate is that 2/3 of the incremental energy requirements in India will come from renewable sources. And India's own energy requirement is going to grow leaps and bounds. So then one of the numbers that I have cited in the recent past is that the per capita daily consumption of energy in this country is about 800 watts, which is meaningfully less than the light in your room right now. That's the per capita daily consumption. For comparison, in the US, that number stands at 9,000 watts. It's 12 times more. India will probably go to 1,300 or 1,400 watts in the next 10 years, which is a huge jump. I don't think there are too many countries that will experience a 60% increase in per capita daily energy consumption. So India will need more energy, and it will invest in more energy, and you're already seeing that. So companies that supply equipment that enable generation and transmission of this energy to the end consumer are obviously going to see very strong order books. And you can already see that in the commentary of such companies. They're already talking about it. So I think that's going to be a very exciting place. Whether stock market investors make money or not is a totally different ball game, because you have to check what's in the price and how much of that order book actually translates into earnings growth. So there are two things to check. And that may vary from company to company or sector to sector. But I think it's a very interesting and exciting space in the coming 10 years.
Okay. One final question, Rhythm, before we let you go. You have your conference that kicks off today. How are you feeling about it, and how is the environment in general? Is there a big pickup in terms of both, activity as well as investments within India? Because we were just speaking to a guest a while back, a global guest, who said that now the narrative is people have gone a bit underweight on global equities, and India is looking like a great piece, which of course is your view as well. But what about the conference? How is it looking so far?
See, Sonia, I think that's an interesting question you ask, and I would actually step aside from just this conference. My interactions with global boards and global investors has been the highest in the last 6 months, and cumulatively more than what I did in the last 10 years. So the level of interest in India is unprecedented, and it's bound to get converted into flows, both FDI and FPI. So I would be hyper bullish on how much demand there will be for Indian assets over the next 3, 4, 5 years. There are a few risk factors we should not forget. I mean, India still has to deal with a general election that's coming up next year, and we have to hope that India votes in a majority government. We have a potential, it's not our base case forecast, but a potential global growth slowdown and a recession, which we'll have to negotiate. But, keeping those things aside, I think the long-term story of India is certainly attracting eyeballs, and there's a huge amount of interest in India, which I've never seen before.
Okay, we'll end on that optimistic note, Rhythm. There's a huge amount of interest in India, which we have never seen before. Hopefully, it'll bode well for the equity markets as well as, in general for the macro economy. Thanks a lot. Great pleasure speaking with you, and congratulations once again on the report, which was so well received. Well, let's do one thing. Let's get back to the markets now. Absolutely quiet. So while we spent a large part of the last half an hour speaking to Rhythm Desai, the market has chosen not to do anything at all. We'll slip into a quick break. On the other side of the break, Saket Jindal of Maharashtra Seamless will be joining in to talk about the quarter gone by. Later in our special segment, Charting Trends, Rahul Sharma will help us decode the charts and technical trends in the market and several counters. Stay tuned.
Welcome back. Well, the market's holding mildly in the green. A few stocks, though, that have spiked up to the high point of the day. Suzlon is now higher in today's trading session. Remember, last week they came out with a good set of numbers, but post those numbers, the stock actually corrected 10% from the peak. Now it's making most of that up. So that stock is higher as we speak. And HPL, I think that's the other stock that was moving well yesterday. Today as well, HPL is higher in today's trading session. A bit of a play on the Indian Railways and potential business coming in there. So I guess that's the reason why that stock is higher. But another big outperformer has been Maharashtra Seamless. The numbers were very, very good. The stock as well is near a 52-week high, and they reported very, very good set of numbers in the past quarter. What's the outlook for business, though, from here on? Remember, they are into pipes. Both they make seamless pipes as well as ERW pipes. Mr. Saket Jindal, the managing director of the company, joins us on the show. Hi, Mr. Jindal. Good morning. Thanks so much for joining in.
Morning.
Well,
Morning.
Let's brush aside first the sales volumes numbers. For the past year, the seamless sales volumes were around 440,000 odd, and the ERW was close to around 82,000. What's the outlook from here on in terms of volumes?
Right. So in the current year, we expect some growth, at least 20% in the sales of both the products. And the exports, which are currently a little slowdown, but we expect it to come back in the next quarter. And the domestic oil and gas sector, there is a continuous, consistent demand. So we are also supplying to NGC subsea line pipes, so which is another value-added product besides the drill pipe. So the domestic demand will remain intact, and we expect a good performance.
So volumes will be higher by close to 20%. We get that. Could you tell us exports in the past year? What was the contribution to revenues? And given that the globe itself could be in a bit of a flux, going by the interest rates, potential slowdown in the United States as well. So what do you see exports contribution in this year at?
Exports would be similar. I think we have been exporting almost 30% of our production, and mainly to USA and Canada. And we will explore new markets also, like we got some orders in Egypt and Europe also. And there are limited tenders in oil and gas in Middle East where there is limited competition. So we will aim for that chunk of orders also.
Okay. What does all of this mean, Mr. Jindal, for your EBITDA per ton on both the segments that you operate in right now, which is Seamless and ERW? What kind of growth do you see in both those segments on the EBITDA per ton?
Right. So EBITDA per ton in Seamless was a good figure. Last year was 20,000, and we expect to maintain that. And in ERW, last year was less, but we will come back to the normal figure, which is, say, 7 to 10,000 per ton.
Okay, 7 to 10,000. But last quarter, it was around, in FY23, it was 8,400. So it will be much better than that, you think, in FY24?
Yeah, we expect through control in raw material prices, there is correction in the steel prices. So by choosing higher value orders, we are targeting to achieve that.
All right, Mr. Jindal, the problem that the street has with regard to Maharashtra Seamless is in the past, when things are very, very good, you're flush with money. But what do you do with that money is crucial. So could you tell us that, given the visibility, order book is good, demand is good, you're talking about good volumes as well, you're sitting on cash actually. Could you tell the viewers whether or not from this money that you're going to generate, will you again go and give some ICDs? In the past you'll have done some inter-corporate lending, which disappoints the stock market. That will not be replayed this time around. Will you focus on capex, focus on inorganic growth?
Right. So we have plans for capex. Like we are planning projects in cold drawn facility and heat treatment facility. So these are value addition on the pipes, and this is one avenue. Plus, we want to upgrade our existing technology through automation. So in the 14-inch mill, which is a plug mill, we can make significant automation, which would be another avenue for capex. So plus we have a plan for making premium connections, which are connections for high pressure applications in the oil and gas sector. And this we want to tie up with the collaborator. We're talking to JFE of Japan and other players.
Mr. Jindal, we have some of that capex plans that you have spelled out. My query to you is that the message you're sending out to investors is all the money that will be generated from the business, all the cash, operating cash flows as well have been very healthy. Plus you're sitting on cash and books. All of that will be used for capex of the company, and you will not go via that ICD route, that is lending to some group companies.
Right. So that would be, we would try to minimize that, and we would focus on our core operations and addition facilities.
Oh, okay. So it's about 800 crores, right? The cash on the books. At any point, would you be looking at any inorganic acquisitions?
Yeah, we are open for acquisitions, and if there is something attractive fitting into our business plan, then we are open to the idea.
Is there anything on the anvil, sir? Since you're sitting close to around 750, 800 crores, and your ICDs by this year, it'll be cleared, right? The money that was outstanding.
It is not certain. Depends if we require for a capex, then naturally it can be taken. And currently, we don't have any acquisition concrete, but we are, scouting around for it.
Okay, I just had one question on exports. You were mentioning earlier how exports have picked up. Can you tell us what exactly is the share of exports in the overall business right now, and how much do you plan to grow it by? Will it also enhance your margins for the improvement in exports?
So basic ballpark figure is around 30%, but in the recent quarter it has been less because of the slowdown in the US-Canada market. But I think we will come back to at least 30%.
All right. We'll leave it there, sir. Thank you very much, Mr. Jindal, for joining us and running us through all of that detail. Thank you. Well, you got the market, which is as flat as they come. I've not seen a 2-point change at this point for the last many days. It's either up big time or mostly up big time, off the highs by this time, but not flat. And that's what the market's been doing, at least in the index today. Let's just take a quick look at the Nifty Bank as well, and maybe we can take a break after that. We've got absolutely flat kind of change coming through. 44,121 or so is where we are on the Nifty Bank. Market breadth is still positive. We've got 2:1 in terms of advances to declines right now. Well, our special segment, Charting Trends, is now what we're going to focus on. Rahul Sharma is Director and Head of Technical and Derivatives at JM Financial Services. Rahul, good morning. Good to have you with us here. Thank you for your time. There's a little bit of, not confusion, but indecision at, new highs, almost at new highs in the case of Nifty, Rahul. How will this resolve, in your opinion? Will we see a big flush push higher, or will we see some more sideways action for a couple of weeks? What's your sense?
Yeah, good morning, Prashant. So after the big rally that we saw, a bit of cooling off consolidation is actually technically very healthy for the markets. But the silver lining, or I would say the golden lining, is the market breadth thrust indicator, which is the number of stocks participating in this rally on the way up, has gone up significantly in the last 10 odd days or so. So although we've seen the index, which has consolidated, cooled off a bit in the last week, but the stocks have not lost momentum. So I believe this is a time to accumulate on the dip. This is a time to buy on the dips. 18,500 for the Nifty remains a crucial support. We might spend some more time in the range of 18,600, 18,500, 18,700. But I think sooner than later, we should be taking out that level. And the 19,000 is something that we see, which is very much on the cards. So overall, we believe technically the market is in still in a good buy zone. And sectorally speaking, I think banks are the ones to go for, especially after the recent cooling off that we've seen. And on the momentum side, I think auto is the one sector which has continued to impress on the long side, and traders will be delighted to trade on this momentum going forward as well.
Okay. Rahul, hi, good morning. So you said autos look best from a short-term trading perspective. Can you tell us some stocks? Is it largely the, Nifty auto companies, Tata Motors, M&M? Because these stocks have run up a fair bit. What more of an upside do you see, or how much more of an upside? And anything in the broader markets that you like?
Yes, so on the auto space, in fact, if you have a mid-cap stock which is in the auto space, that is the best combination you can have because that is where the maximum action is. One stock that we like from this space is TVS Motors. The two-wheeler auto space has done very well in the last few weeks, and TVS is one of those setups which has seen a bit of consolidation in the last few days, but the trend still remains pretty robust, trading above all its short-term, long-term moving averages. I think there is a quick 7-8% upside to be had in this stock. And like I said, momentum is very much there on the auto space. And if it is a mid cap, it only adds up to the fire. So TVS is something that we like. Apart from that, on the capital goods space, L&T is something which remains a very good buy at these levels. The risk rewards are pretty favorable on the long side. 2400, 2450 is where we see the stock in about a month's time from now, and L&T can be accumulated with the stop loss placed at 2200 odd. So capital goods is another space that we like, and apart from that, I think banks, especially the ones which have not done well, like for example the laggards like SBI, PSU banks have not participated in this rally. Then you have an HDFC Bank which has seen a decent correction coming up in the last few days. So these are two names, SBI and HDFC Bank, especially given the extremely good risk reward in these two setups, we feel that in the next leg of the rally, these two stocks should do well on the upside.
All right. Hi, Rahul. Rahul, what about the Nifty Bank? You're saying it's good for more. The Nifty, you see it headed towards 19,000. On Nifty Bank, where are we headed?
Yeah, so Bank Nifty, I think 43,700 is the very immediate support for the index, and still continues to stay pretty strong. As far as levels are concerned, I think 45,000, 45,500 is where we look at it in the very short term. And structurally speaking, I think this index has got long legs. 50,000 is where we see the stock towards the end of this year. So this has remained a sectoral leader, and I think it should continue to do so. I think the next leg of rally should come from the PSU banks, which have remained fairly underperforming in the last leg of this rally that the banking stocks have seen. So 50,000 is where we see the banking index in the 6-month time frame from now, and in the very short term, I think 45,000, 45,500 is where we should be headed for.
Rahul, you have you like L&T?
Yes, L&T is capital goods have had the time of their life in the last 12 odd months or so. L&T is one stock which has considerably seen good buying interest. Every time the stock has come close to its 100-day moving average, we've seen buying happening. I think this time also it should not be any different. We've spent like a good 10-12 trading sessions around the 2200 mark. And I think now the stock is ready for another leg of up move. So a new all-time high, I think 2450 is where we are seeing the stock at. Around 10% upside can be had from these levels. So L&T, remains our top pick in the capital goods space.
Okay, L&T is your top pick in the capital goods space. Got that. Any other stocks that stand out for you before we let you go? Anything that you like in the near to longer term?
Yeah, so cement is once a sector which has seen a revival in buying interest today. Grasim is one of the stocks which can be looked upon for trading on the long side. I think the sector overall has done well, and Grasim is one of those setups where we feel that a new all-time high should be on the cards in the coming couple of months time frame. So structurally, the cement is in a bull run, and it's all about cherry picking and identifying the ones where the risk rewards are favorable. So maybe with a 17, 16, 80 kind of a stop loss, one can look to buy Grasim for delivery. I think 1900, 1950 is very much on the cards as far as the Grasim is concerned.
All right, Rahul, we'll leave it there. Thank you very much for your time. Appreciate it very much on CNBC-TV18. Well, it's a quiet kind of a day with just a 10-point change. IT is the one sector which actually is selling off. The mid-cap index is flat, and I think we've got the small-cap index which is not doing very much either. The small-cap index is down a 0.1, up 1 point. That kind of day is what we have. So the top losers list is completely populated by technology stocks, both large and small. And then you got, IEX, which is, of course, news-related. We highlighted that earlier, 1.6 lower. Jindal SAW is coming up with a 3.5% cut. Sobha is down about 2%. The non-IT names, some of them are, I'm just mentioning, Thermax is down about 2.5%. Indocount, which has done quite well last 4 or 5 sessions, that is coming under some amount of profit taking as well. Car trade had a very large day yesterday on the upside. That is seeing some pullback with a 3% kind of a knock this morning. So that's the losing stuff on the losing side. Nelco is up 10.5%. Nelco is coming up with almost 700 on the board. That's a big move on very large volumes as well this morning. Aegis Chemicals, I think, is the other one, which is up 6.5%. It's got a very large move. We highlighted HBL Power, which is basically, they also, along with a JV partner, are into railway anti-collision devices. It was up 10% yesterday. It's up another 5% this morning. And of course, Mazgaon Dock we highlighted in the morning. That's looking good. Ambuja Cement, perhaps a new one into the mix. It's up 3.5% on volumes this morning at about 455. So that's the action. We'll take a quick break here. We discuss what's happening in the commodity space. Manisha will be with us with some stock, with what's happening on commodities. And of course, we highlight some specific stocks with our research team. Stay with us.
Welcome back. Let's get a quick handle on what's happening in the world of commodities. Now, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at the metals as a sector today because we've seen some buying come back onto this one. Copper for the last couple of days has been shining, but zinc is back in the positive right now. So is the case with silver. We've seen some of these metals actually gain because there has been some softening in the dollar index. The treasury yields have declined a bit, and that all is because of the US data that we saw in the markets yesterday. The traders also are looking at the Chinese trade data that comes in on this week as well. So So ahead of that, there is some buying that we've seen into the markets. Remember last month when all of this data came in from China, it was better than street expectation. That clearly has been supportive. The US ISM Services PMI shows a sluggish growth, and that tells you that perhaps the US Fed will not hike rates on 14th of June when they meet. And there in any case is a nearly 78% probability right now of pause in rate hikes when we meet on 14th of June. So that really seems to be supporting right now. I mean, it's trading quite flat to positive, as we can see in silver. It has been a positive opening in the Asian markets, China that is, for zinc, copper, aluminum. All of those metals have been trading higher. The higher rates in US, UK, Europe continue to weigh. Is the reason you haven't seen a runaway rally come in for this one. But copper prices, let's start with that. And those prices gained up by 1.5%. We are trading at 8,360 right now. Last month, we did see copper prices break below $8,000 per ounce as well. So it has been $300 to $400 of a jump up there. Also, when you look at the copper cash to 3-month spread, that has declined quite sharply. $2 now versus $66 a ton in the previous couple of weeks itself. That tells a different story, of course. But the markets also are looking at concerns in Peru and Chile. You are looking at lower production from there. And there was a Julius Baer report last night which says $8,000 is a good buying opportunity for copper. It is expected to hold support at those kind of levels there. The other metals have done well. Silver and zinc, for example, are doing positive. Zinc has come off its 26-month lows. We saw the prices decline by nearly 15% for the month of May, but June has started on a positive note. The LME inventories at 49,000 tons are just about at 2 days of global consumption. That has been supportive. And even as a lot of smelting activities have picked up in China and Europe right now, the markets still believe that the kind of demand expectations that there are by the third and the fourth quarter, you still are looking at lower inventories. Silver as well trading in the positive. We are looking at prices off 2-month lows. We did see prices decline all the way to 22.5 as well. So we are back around 23.5 on your screens. For silver as well, the industrial demand for the month of May has been positive. Also, this is going to be a 4th straight year that you are looking at a global deficit in case of silver. Last year was a record deficit, and that's exactly where the markets are taking support from. This is what we've done on a week-on-week basis. So last 6 or 7 trading sessions, it has actually been positive, as you can see, across precious metals and base metals as well. The only thing that's trading in negative and a marginal negative has been zinc, and we have seen buying come back onto this one as well in the day-to-day.
Okay, all right. Thanks a lot for that, Manisha. Well, let's focus on a few stocks then that are moving around. JK Cement, well, they made a small acquisition. They are buying the Toshali Private Limited's unit, and that's the unit in Odisha. So 2 units is what they're buying. One is the integrated unit, that means it's backed by clinker. And the second one is the plain grinding unit, which is close to around 0.4 million tons odd. The transaction, well, there are certain conditions that need to be fulfilled, but they're saying that in the next 6 months or so, it should get closed out. The total cost of this asset is small, 157 crores, or that works out to around $30 per ton. Why is this positive? Well, valuation is good. Obviously, it's a small asset, so that's good. It gives them an entry into East India. And also, both these 2 plants are operational. So I guess the street is reading that positively. But on the flip side, what's not doing well is IT companies. Rima joins us to fill us in with more details on that. Rima?
Thanks so much for that. So the reason IT stocks are lower in trade across the board is because one of the global companies, it's a company called EPAM, which is revenues of about $5 billion approximately, and they have cut their growth guidance. And the guidance has been cut just 1 month after they had given their previous guidance. So the company is EPAM. The company reported their numbers, Q1 calendar year 23 numbers, on the 5th of May. At that time also, the company had lowered the revenue guidance. And now 1 month later, on the 5th of June, the company has further brought it down. Let me run you through how the evolution of the company's guidance has been. In February of 2023, when the company reported last year's full year numbers, the company said this year, in calendar year 2023, EPAM will see a 9% plus revenue growth. Then on 5th of May, when the company reported their Q1 numbers, they brought down the 9% plus growth to 2.5% to 3.5%, which means at midpoint, the company would have at least done 3%. 1 month later, the company has further brought it down, and now they're expecting a decline of either minus 0.5% going up to minus 3.5%. At the midpoint, we're looking at a minus 2% decline for EPAM on the top line in this current year, which means in 1 year, their growth has been brought down by nearly 5%. The company's commentary says, in the weeks since our Q1 earnings call, we've seen our clients become more cautious with spending, specifically in the bill segment of the global IT market. After careful assessment of changes in our May and June forecast, we have come to understand that the pipeline conversions are occurring at a slower rate than previously assumed. That said, what you need to understand, the difference between EPAM and many of the listed Indian IT companies is that EPAM has a very high exposure to the discretionary spending. But the Indian IT companies, particularly some of these large ones, they have a fair balance between their legacy in maintaining the IT systems, operating systems, versus the discretionary spend. So the impact of tighter budgets, spending cuts typically happens in discretionary spending, in discretionary projects, where EPAM is more affected rather than the Indian IT. That said, but even Indian IT companies will see a rub-off or a flow-through. Back to you.
Stocks are under pressure. By the way, there is news at the bottom of the screen. NSE, via a circular, has changed Bank Nifty futures and options sort of expiry date from Thursday to Friday. So weekly contracts will expire. They used to expire on Thursday of every week. Now they're going to basically expire on, the expiry is going to be on Friday of every week. The monthly and quarterly contracts for the Nifty Bank, which used to expire on the last Thursday of the expiry month, will now basically expire on the last Friday of the respective expiry month. And of course, I mean, if that Friday is a holiday, then the expiry will happen one day prior, that is on Thursday. So these are important changes which are coming through. Bank Nifty options, of course, I mean, one of the most heavily traded, I think, by far. So, you know, we'll get some perspective, some opinion on this in terms of whether this will mean, what will this mean, and try and get you a response from the NSE as well in terms of the reason for this, the change which has now been sort of put out via a circular. So that's some changes on the regulatory side, technical changes in terms of expiry for Bank Nifty F&O. Well, time for a quick break here. On the other side, our special segment, it's the economy. Lata will get chatting with Harsh Damodaran, Rural Affairs and Agriculture Editor at Indian Express, and Ramesh Chand, member of the Niti Aayog, to talk about monsoon and, of course, the consequent impact on the economy. Stay tuned.